Look at me.
Hey!
Good job.
Okay, so
Pre
is it the three of us so far?
Now we got Jay, we got Iris, we got Marla, we got Liz, we have
Oh, great.
Katie Burgess from Brighton Jones, who is a very well trusted advisor that I just her and her team are fantastic. Anybody ever has investment questions, I want them to please reach out to Katie and their team because I have the utmost trust in them and they really do a good job. So, really good introduction for them. Um, this team at Windermere has been really good to me, and so is Katie, and just happy to make introductions. So that's fun.
Well,
And
thanks, Jim.
hopefully
Big
we'll get
compliment.
some, absolutely. Hopefully we'll get some clients with questions on with us tonight. Katie will be with us in October as well, so that'll be good. But just trying to get her more introduced to the group, and Marlon knows Katie as well. And we got Alicia as well who's joined us, which is great. So um, good to see you, Alicia. We have her. So Katie, I kind of want to start, and I
Mm.
sent you my plot here.
Yes.
This one's a big one to me because I brought this up actually in today's meeting that I think is really important because one, I think most folks know now by all of my my talking in office that when the Fed moves rates, it's really not directly impacted to mortgage rates in general, but it does make a major impact to finances overall. I mean, it's a big deal for home equity lines. It's a big deal for car payments. It's a big deal for credit cards. Basically, the Fed funds rate impacts so many markets, but it's usually more personal financial. Like, what do you see on your side when the Fed makes a move like this?
Yeah, it's interesting. It is a bit of a misconception, right? Like, oh, rates dropped, and that must mean that all the mortgages dropped too, right? It's like, not necessarily. There's context there. Um, but in general, when we think about fixed income portfolios and what we can expect from them in terms of yield, performance, forward-looking projections for that, that's really where that comes in. And if you're in a bond fund, as an example, many of my clients are instead of an individual bond, what you do see is when the Fed drops rates, that we see a nice price appreciation on the bond portfolio in general, because you're basically compensating for you're not going to get quite as big of a yield payment going forward. So that bond that's now paying 4.5% when the Fed funds rate is 3.75 feels more valuable to people. They're more interested in buying that. So there's that. I think markets also tend to like rate drops. That's a bit of a just investment like investor sentiment thing that happens there, but the idea there being there's going to be more money that's available for circulation for buying goods and services, right? And it's going to free up cash flow for folks who are going out and getting loans or just going to the grocery store, buying things off Amazon. It's going to boost corporate earnings, that type of thing. So we see a lot of that, and generally markets celebrate rate drops. On the flip side, when rate hikes happen, markets do not love that because it's restricting that buying power. So I think it's a double-edged sword in many ways because the Fed's going to come out and say, yeah, we're going to do this, but right. And
100%.
pricing in future rate cuts or not has a big indication on where markets trend over a shorter term period.
So, and we're going to break that down a little bit further, but like this chart specifically, I want to explain it real quick. So, what this is all the Fed funds members basically projecting where they think the Fed funds rate should be at the end of these years. So, why I think this is super relevant right now is, like Katie said, the Fed funds rate, depending on what marker you look at, it's either 3.75 or 4. There's always a quarter fluctuation to that. And this is basically showing us that a majority of Fed members by the end of 2025 want their funds rate to be 50 basis points less than it is today. Or like again, regardless of what market you look at. Why I think this is so important is because mortgage rates typically trend about 2 to 2.5% above the Fed funds rate. And again, it doesn't happen overnight, like she suggested, and like some of the videos and stuff that we've sent out. But over time, they are correlated. It just takes a long time for that to move through the markets. And Katie was talking really specifically more about like returns on fixed incomes and things that she has her clients in. But I think this is so important to look at because you can kind of see in 26, you're starting to see a big group of those Fed members want to see those rates closer to 3. And you're starting to see a big group of those members wanting maybe to see 2.5s in 27 and 28. And I think that's so important because, well, first of all, we cannot project 27 and 28 based on the last 2 years. That's impossible. But it is good to see that a majority of members potentially want to see some relative drops in the next year and a half. And again, why that's so important is because mortgage interest rates tend to follow this in big picture, right? So if we've got interest rates on the Fed side around 2.5 to 3, that tells me that over the next couple of years, we should see mortgage interest rates maybe 5 to 6. And that's obviously very important to everybody on this call from a real estate agent and client perspective. So that's why I think this is very positive. Uh, Katie, tell me a little bit more about, like you said, fixed income and why that's important to you guys as far as a investment portfolio. Like, what does this mean for your clients that were in those portfolios 6 months ago versus today?
Yeah, again, I think for the fixed income portfolios that are in existence, which all of our clients have some level of fixed income in their portfolio just from a hedging standpoint, right? But really, we've seen when the Fed drops rate, we see a price pop on those fixed income portfolios. What that means is the value of your bond tomorrow is worth more than the value of your bond today when the Fed drops rates because we're managing to a certain maturity. So those 1 to 3 year bonds now look a lot better or more attractive because the short-term rates have fallen. So new issues are going to be priced in at a lower rate. You'd want to buy the older ones. And I think it's a complicated equation for a lot of investors to really understand bonds because it is that inverse relationship. You're getting paid a certain coupon rate for holding on to this for the time frame that you've selected to hold on to it, but the value of that bond does fluctuate in the middle of holding that. And you could go and say, "Hey, Jim, I want to sell you this bond, and because I need the cash today, and actually this is better than what you can go buy yourself, so I'm gonna just charge you a little bit of extra money for taking it off my hands. Thanks for the cash," right? So it's a good scenario for both you and me, and just explaining that inverse relationship when it relates to multiple rate drops or rate hikes. We've lived that over the past couple of years as well. Explaining that and saying, "Hey, here's how the mechanics really work, and here's why it's still worth investing in fixed income, even a falling interest rate environment," is a conversation that I'm having a lot these days.
Me too.
Yeah. I
So
think the other piece too is it's predictable, right?
yeah,
So
it is.
to an extent, it's more predictable than, whatever earnings report you're looking at on the stock market, right? So if somebody's saying, "Hey, we're going to be buying a house pretty soon and we need to figure out where to park some cash while we're looking," it's not going to be in the equity market because we do not know what that's going to do tomorrow, but we can reasonably guess what kind of performance we can get out of fixed income instruments. And I think that's worth holding on to in any environment.
So that's an awesome point. So, personally, I've parked a lot of cash in basically money market accounts because you've been getting a really high yield
Mhm.
return on that. So, like, talk to us a little bit about what the Fed drop means in that scenario.
Yeah, I mean, really, that just means that on a forward-looking basis, Jim, you're getting a quarter point less than you were
That's
yesterday,
it, right?
right?
Exactly.
Yeah, and I think that's the trade-off with cash or high yield accounts in general. You're not going to get that price appreciation. That's the price you pay for having it in FDIC insured
And,
vehicles.
and this is such an important piece because, like, things change so fast. So, a year and a half ago, when you're getting a 5.25% return on cash, that was a crazy good investment. But now, if you're looking more like 3.75 to 4, to me, that's why it's so important to work with an advisor that understands that things change quickly.
Mhm.
And when things change quickly like that, you have to adjust your financial strategies. Obviously, no one's the same. So it's a really hard question I'm going to ask you. But like in general, like how are you kind of prepping your clients? Obviously, age 60 versus age 30 is a lot different from like how you're setting up portfolios. And what are you doing with clients that like come in the door today that are, let's start with age 35, because that's a demographic that, in my opinion, over the next 2 to 5 years, we're going to see an unbelievable influence in the home buying market. And that's kind of the topic we want to specialize on tonight. Like, what are you telling those kind of clients as far as preparation? You mentioned, we want to park money and stabilize returns because might want to use this money in the short term. But like, how are you structuring those conversations? And again, I
Yeah.
understand everybody's so different, but in general, like, how are you trying to put that plan together?
Yeah, well, the first thing we do ask is, hey, what are the big outlays, right? What's coming down the
Yeah,
pipe? And if it's not buying a house, maybe it's, are you looking to fund a remodel? Are you looking to buy a car? Are you looking, how's your job going, right?
right.
And what we do is try to understand from a savings capacity lens or a cash outflow lens from the portfolio, how do we need to be structuring this so that we make sure we have a conservative enough bucket to pull from if XYZ happens? It's very, very rare, especially at the 35-year-old level, right? That there's nothing coming down the pipe or there's nothing
Right.
that they're thinking about just because you're still building, right?
No,
And on the
it'll be
flip
like
side,
it'll be a conversation of like, yeah, nothing's coming, but my wife's pregnant. We're gonna buy a house. You're like, wait a second.
yeah, those would
Besides
arguably
massive.
big. My favorite is the folks who don't have kids, right? And they're like, "Oh, nothing's going to change. There's
You're
no
right.
there's no additional expenses that are associated with that." And it's like, oh, let's just build some in anyway, right? So what that's where we start though, right? Is trying to understand what is coming. What do we need to be planning for in, I think you said it well, the next 1 to 2 years to
Yeah.
start thinking about, hey, we need this in cash, money markets, short term bond equivalents, and then everything else we feel comfortable either getting longer on the yield curve with in terms of like lower credit quality, fixed income, foreign fixed income, that type of thing, or more traditional equity investments, because you still want that to grow. But the worst case scenario for a client is we told you that we were looking for a house. The markets fell out 20% because something got tweeted, right?
Yeah.
And now where am I sourcing my down payment from? Now I'm
Yeah.
stuck looking, adjusting my expectations for that, right?
We definitely saw that in April and May, right? Like
Mhm.
that was had to be maybe the worst 60 days you've had in quite a while. Um,
Well, 2020, but yeah.
yeah, that was challenging too.
Yeah.
From that perspective, though, when you're working with clients, I guess this is more of like a goal setting strategy, and like I guess a really direct question is like if somebody came to you today and said, I've got X amount of dollars to potentially invest, and here's my 2 to 5 year outlook. Like, what's your recommendation, or are you taking on clients with an X minimum? Are you like, what do you guys do at Brighton Jones as far as like for all these real estate agents who are on here that have clients that might want to buy in a year or two? Like, could you take on a client with 30, 40, 50, 60, $100,000? Like, what are your minimums as far as a company go? I think that's a really important number to know.
Yeah, we have a couple of different divisions at Brighton Jones. So where I sit and live is in what's called the personal CFO division. And really that's people with investable net worths where our pricing tends to make sense in that $1 million plus range. That said, a lot of clients and certainly, intergenerational type, hey, I work with the parents and the kids are working and building and growing. We have a solution for that too. It's called Open Plan. And that's
Cool.
just a little bit more of like, hey, I've got, 401k assets. I need planning. And we don't really have a minimum in place there. It's more of a subscription model, and you've got access to a CFP anytime you want, that type of thing. And we build foundational plans for people. So if there's a need, I would say we've got an option there. And the advice really doesn't change. Obviously, with $1 million balance sheet, things look a little bit different. You have different options available to you as an accredited investor, that type of thing. But ultimately, we always say just tell us what your goals are. We'll try to put you in the right place so that you're getting the advice you need at that time.
I think that's so big because I've been told by clients that they've been declined from like
Yeah.
financial advisors, and
Mhm.
like it might be 50, 75, 100,000. It takes a long time to save that. And I think that's
Yeah.
such a challenging response from some of those big advisors out there where you're like, hey, I want to invest with you. You're like, yeah, no, you're
Yeah.
not big enough for us. I think that's a really important point to make on this call to everybody that's on it is these guys will help anybody as far as like a meeting, building a plan, doing anything with like it doesn't matter the investor, it doesn't matter the client that has goals in the next 2 to 5 years. I think that's so important to note that even if they don't have a big portfolio, they're not getting turned away from a team like Katie at Brighton Jones. I think that's so important for everybody to hear on this call. And but again, I've talked to clients that have felt like, oh, they were too big for me, and then
Mhm.
all of a sudden 6 years roll by and they haven't bought a house because they didn't get the planning strategies that they needed because they didn't talk to a good realtor, lender, or financial planner, and now they might have missed out on a lot of equity potential. And from that perspective too, Katie, like as far as tax strategies and stuff like that,
Yeah.
one thing that I love about Brighton Jones is you have departments for that, and I think that that's super rare. Can you talk a little bit about that, like the tax strategies and the financial planning that you use, like with a home purchase, with the whatever client that you're with? Like, talk about your divisions a little bit. I think that's super cool.
Yeah, sure. So we were founded by two CPAs. So
Oh,
it's
that all right.
yeah. And it was in 2000, and it was a time when financial planning, it was, everybody called their accountant, right, for their financial advice. And there was a real need, though, for holistic financial planning in the space that incorporated actual financial planning that goes just beyond cost basis and tax advice, right? With that same tax advice that people should have access to, so that you're not kicking off excess gains or you're not making just really bad decisions on the portfolio side that don't make sense with your overall tax strategy. So we definitely speak that language because everything you're going to do from a financial lens is going to have some sort of tax impact to it, right? Even the act of taking on a mortgage, right? And paying interest on that mortgage, there's a tax deductible piece of that. Suddenly you might be
Yeah.
itemizing depending on the size of the home and the size of the loan and all of that. So we're really well versed. We do also have in-house CPAs that if a client says, hey, I'm interested in having somebody else do this for me, not filing on the TurboTax, or I don't like my current CPA, will often say, and it depends on complexity, right?
Yeah.
If it makes sense to use our in-house CPAs versus somebody else who specializes in something else, if you've got multinational foreign CPA reporting, I'll be the first to say like, hey, not our group, but we play nice in the sandbox with anybody, right? And we understand how to speak that language and loop in the experts when necessary. I say here in Seattle. So a common tax situation that we see is I work at XYZ tech company. I have some form of equity compensation along with my base and maybe a small bonus. I am paying huge tax bills every April. I don't know why. I'm tired of the penalties. I don't even know what I make. I don't feel like I have that much money or that much cash flow. So how could I possibly be paying this much in taxes? And that's
Heard that a
something that,
lot more than you think too.
yeah, yeah, so we talk a lot about that. We talk about estimated payments, utilizing equity as a part of the strategy for freeing up cash flow or really having a diversified allocation so you're not so concentrated in one stock versus the rest of your overall portfolio, and then balancing cash needs alongside all of that tax planning too. And I heavily lean on the in-house team. And even if they're not, a tax client necessarily, I've got, my person that I just shoot a Teams message to and be like, hey, random question,
Yeah.
sorry, it's April 2nd, but I'm going to ask this question. So it's a great resource to have, right? To be able to understand what the impact is for people and then be able to mock up even some projections to give people parameters around what's feasible when they think about home buying or how it's going to impact their overall tax situation.
So let's talk about real estate in general from that perspective. So
Mhm.
let's say we've got a client that's lived in their house for 25 years. Obviously, we've got a massive appreciation over that time period. Like, how could one of these realtors on this call, would it just be an email to you with a client that says, hey, I've got, I owe 200,000, I'm going to sell this property for 1.6 million. What do I do? Like, is that
Mhm.
something that they could come to you with and just say, I've got a tax problem coming.
Mhm.
Like, how can we fix this? Is that something that you could be a resource for?
Absolutely. Yeah. And I'm always happy to, I do my own little CPA light work on the side where it's like, okay, yeah, King
I'm
County
also an
excise
unlicensed
tax.
CPA.
Yeah, for sure, right? I can do a back of the envelope pretty good. But yeah, absolutely. I think the the biggest mistake that I see with situations like that is I just made however many millions of dollars, right? And I'm going to throw it into something. And then in April, I'll be like, oh, shoot, I've got to
Yeah.
pull all that out, and it's all short term gains now, and I'm going to pay taxes on that additionally. And I think just getting a plan in place before any of that happens and being strategic about understanding what that liability could look like when you need to pay that in, how Washington's capital gains tax plays a role, which luckily for real estate, it doesn't, at least the way it's written today. But we all know how that goes with Washington and those legislative sessions. So I'm not holding my breath. But anyway, I think the point is having that foundational piece way ahead of time is super critical. And I would love to be a resource to anyone on this call if you're finding yourself or your client is finding themselves in that situation.
I think that's so massive because, like that scenario we just brought up to start that conversation is very pertinent in this area, right? Like you had home prices at 500,000, they're now 2 million. And what's that person going to do with their potential gain on that property and just listing it, getting that cash? All of a sudden, you don't have a plan in place. That could be a real problem. And
Yeah.
I think that without thinking about it before you list that property, you find yourself in a pigeonhole saying like, oh no, what do I do next? So
Mhm.
even just like a conversation with you guys around that before that scenario hits, I think is so important because, like you said, um, there's limited knowledge out there because this
Yeah.
area is really unique. Like San Francisco went through this 15 years ago, in my opinion, around like, oh my gosh, these properties just went up drastically in value, and there's a big wealth accumulation when that happens. And
Mhm.
I think we're going through that right now in Seattle East Side too. And I think that those folks that were Boeing, Microsoft early are now finding themselves in a position where like I actually don't know what to do here. I knew what to do 15 years ago, but I don't know what to do anymore. And I think that having a resource like that is incredibly powerful. So that's awesome. I'm going to bring up a kind of hot topic that I talk about more than I think a lot of people do, is just recession in general.
Mhm.
And I think that's something that is super important. And I talk about this a lot because of what it does to housing. And in general, we see interest rates go down during a recessionary time. We see home prices do relatively well because with less interest, you see the ability to afford more with a cheaper interest rate. So in general, in my opinion, housing has done incredibly well. So I'm going to jump around a little bit right now. And most people in this office are going to just shake their heads because I show these slides all the time. But in general, when you see the unemployment rate start to jump a little bit, you typically see a recession. Typically, when you see a recession, mortgage rates fall dramatically, like 20 to 30% historically over the last 30, 35 years. Home prices, on the flip side, drew really, really well. And again, that's because you can afford more of a payment with a cheaper interest rate. So I'm going to kind of put you on the hot stove here, Katie. Is
Hmm.
a lot of people are saying soft landing. A lot of people are saying there's going to be no recession. Unemployment rate is going to stay super low. Interest rates might go to six. I personally think we're kind of in not a banking recession. I don't think unemployment's going to 10, but I really do think we're going to see kind of a normal recession over the next year or two. And in your opinion, like, what have you seen during those times from the financial advisor lens? And what are some smart moves for people to make, or at least, we've kind of touched on that a little bit. Fixed income, we've talked about being smart as far as diversification with different asset classes. But in my opinion, recession in real estate is actually not the worst thing in the world because you start to see cheaper money. And I
Hmm.
think you start to see, especially if we maintain locally in these big tech companies, that's the one question mark that I think that we have with the new AI coming out is, do we see employment stay strong? And if we do, we'll go into these slides later on, but you guys, we still have such a deficit in homes to be purchased. Like there's so many more able people to buy than we have as far as inventory numbers go. Even right now, where it's been a little bit softer on the sales side and a little bit more buyer friendly. Like, what do you see on the financial advisor side when you're hearing the word recession? Like, give us kind of your breakdown on that.
Yeah, I mean the big R word, right? Nobody likes it.
100%.
Um, I agree with you in general. I think we have had such a good run for such a long time with very few there's been a few blips here and there, but largely we're in this massive bull run, right? So
Yeah.
just from a true market perspective, and the markets aren't exactly aligned with the timing of a recession. Normally, there's a kind of reactionary period there, but I find it hard to believe that the other shoe is not going to drop on how sky high these valuations are, just given the unemployment numbers that we're seeing and the rhetoric around them, the pressure to reduce rates that the Fed is facing right now. I agree with you. I mean, soft landing would be great, but it feels like like a lofty goal at this point, right? And I think a pullback would actually be very healthy for the markets in general from a future upside perspective. Now, the only thing that makes me kind of put a caveat in there is that corporate earnings continue to be extremely strong. So there are some fundamentals that are backing up some of these prices. Now, should any single stock be trading at like, 4x the S&P 500? I don't think so.
Um,
That still feels
some of these
really
PE ratios are insane.
yeah. Yeah. So and there's always going to be that. There's always going to be things that are trailing and things that are just way ahead and leading the charge. And that's the case. Will it be the same for companies in 20 years that it is today? I don't think so. Absolutely not. So something we're really telling clients at this point is we are intentionally putting aside dollars on a longer time horizon than we would need to, and it's all based on valuation. So we're not even thinking about like what's going to happen over the next 2 years, right? Because
Yeah.
if that happens, that's priced into fixed income allocations at this point because valuations are so sky high. We're giving our portfolios a 15-year timeline before we would technically need to pull down on them to fund lifestyle needs. And that's really the way that I think about it is that timeline. How long is it going to take to recover from a return perspective to get to where we were and the other side of a recession or a pullback or whatever that ends up being? And we've been in that place for a while. I'm not sure that anything has really substantially changed
It
over the
feels like we've
past.
kind of talked about that for almost like 2.5 years, like
Yeah,
in the markets in general. Like, have
yeah.
you kind of felt like that same horizon, or have you felt it more recently? Have you felt it a little bit more like 2 years ago, or like obviously April, May? That was probably a huge question. Is this going to continue downward? But
Hmm.
has it been more recent? Has it been like 2, 3 years ago? And to me, it feels like we need to pull back for almost like, I don't know, 5 years.
Yeah, I agree with the 5-year timer. I mean, the yield curve's been inverted for a while,
Yeah,
you know? And that's usually your leading sign of,
yeah,
hey, something's coming, a recession's
yeah.
coming. Now,
Right.
when it happens, I think we've been just kind of floating along on reports for the time being,
Yeah,
but as long as we're being conservative enough to tell people, hey, you can ride this out and planning enough to, say, hey, I'm telling all of my clients right now, if we're seeing a run up in equities, let's take those gains. Let's harvest that. Let's shore that up. I could be exactly wrong. We could continue to trend upwards and that's great, but the confidence in the plan and being able to say we trimmed profits when we had profits speaks to a lot more investors at this point because I think people are feeling the exact same way that we're talking about. It's the bulls are it's been running for a long time.
well, it's wild to think that it can continue this way. And like
Yeah.
I pull these charts up all the time, so I'm gonna pull up the S&P 500 real quick. I mean, this is wild. Like just to see this run up like constantly for
Hmm.
like even like last 2 years, like with a little blip, like that is insane.
Hmm.
You can't count on that. So like that to me like speaks to like having again a balanced portfolio and like
Hmm.
having a plan B for what you're gonna do if things don't continue in that direction. So that makes a lot of sense to me.
Yeah, I think the biggest disruption to plans in general on the recession piece is really the unemployment rate, right? Because we can say all day, well, it's fine if you're covering expenses, but if you get laid off, and we're already seeing that a lot in the tech industry, just massive rounds of layoffs
Yeah,
from Microsoft and Meta and all these companies, right? That's going to disrupt the plan. And that's why I think we need to be honest with ourselves about where we see the influence of AI, right? And the influence of just the job market in general, because that's going to be the piece where it's like, yeah, now I'm really interested in trimming some gains and
yeah, let's talk about that a little bit more. So, from my perspective, we've had a lot of clients that have called and said, like, I don't know what the next year looks like. I've got a lot of equity in my house. Can I pull a HELOC to, have a fallback plan if that happens? You can do the same thing on investments too. Like, you can set up a line of credit. We've used this kind of technique for different clients and almost use it like bridge funds
yep,
for a down payment. But like I've never really thought about it too much as far as a fallback plan for potential layoffs. Like, is that something you would even suggest in that scenario, or would you consider? Because it's really similar. Like, if you're doing a home equity line of credit, you're looking at somewhere between let's random numbers 6 and 9% from a
mhm,
home equity line, depending on what your loan to value is with your combined current mortgage plus your HELOC. Like, what are you seeing as far as like using an equity line like that as a fallback plan too? So you're not selling equities and creating a taxable event. Have you used
yeah.
that strategy at all, folks?
Yeah, we do have margin loans available on portfolios, and I'm careful with these, to be honest with
Mm-hmm.
you. The primary custodian that we work with is Fidelity, and they have margin requirements that, they'll go up to 50%. I don't even
Yep.
like hitting 35 with that because if the markets pull back in any real way, the worst case scenario is you're in a margin call situation and you're selling things at lows, right? So that's an option in addition to pulling funds from HELOCs, that type of thing. And we'll use it in short-term situations. Certainly to get into a house between like hey, I'm buying something today. I just need some time to sell, right? But we
Yeah,
really
because
think of that as,
you got a full picture plan. Like, I'm
yeah,
buying property A, I'm going to sell property B, I'm going to repay this at least
yeah,
down to X amount of dollars. And at that point, your margin call is very low risk
right,
if you're looking at it from that perspective. But you haven't
exactly.
really done it much as far as like a backup plan. Like from that perspective, you would probably rather see a home equity line
Yeah,
because you don't actually have a call in place if you're looking at it from oh my gosh, I'm worried about
Uh,
job
on
stability.
Zoom.
yeah, exactly right.
Oops. Oh, sorry, Katie, I muted you on accident. I was trying to mute somebody else.
That's okay. Am I back?
There you go.
Okay. Yeah, exactly right. I think the way that equity in a home is valued is different than a share of something that's going to mark to market day in and day out. That feels a lot less risky if you're paying an interest rate on that either way. But w again, I will use these for it. It's December. It does not make sense to harvest gains anymore this year because it's going to bump you into XYZ bracket or something, right? So maybe we do this on a very short term basis, knowing that we'll be able to repay that in January, as an example, at the start of the new tax year. And again, if you've lost your job, your tax situation is going to look different in the next year. That's a bit of a gamble too,
Exactly.
because who's to say you don't get a job in February and you're right back where you were in terms of the tax brackets and that type of thing. But in general, I think home equity is a great place to tap if it's available to help fund short-term things like that. And again, I've mentioned a few times now, but all of my clients have a fixed income allocation that you can tap.
Yeah.
And I'm pretty comfortable saying, hey, we've got a baseline 10% here that you usually don't need, but this is exactly what it's for. And that's not going to have big gains implications one way or the other. So I'm okay with running hot in situations where we need to as
Well,
well.
like you said too, if you're not getting income from the job and you're getting fixed returns on some of this, you're not going to knock yourself into different tax brackets at that time. So
Yeah.
that makes a lot of fun. What's like been the hottest question you've got from clients over the last couple of months? Like, do you have like a two or three that you're getting constantly?
I'm getting a lot about what's going on with the Fed, right?
Because we need both.
Yeah. Yeah, a lot of people are interested. I mean, the news cycle that we're in right now is extremely
Yeah,
interesting. So there's a lot of chatter in many ways. I think people in general feel this deep sense of uncertainty around what's going to happen
yeah,
next. And I've been in this industry for 8 years. I have always gotten the question in all 8 years. So we're spanning multiple administrations and that type of thing in that time frame. But I've gotten the questions around, well, this feels different. This feels different for XYZ reason. And we can look back and say, here's why it wasn't different. But that's not a good answer to give a client when they're calling you panicked on the phone,
yeah.
right? So a lot of the questions we're getting are around recessions and around where our interest rates going and how long can we really expect these companies to keep doing so well and should we be selling right now? Should we be locking this in? And I think it's all very specific to an individual plan and individual resources. And, are you retired? Are you working? Or are you planning for anything big? But again, I think it really just comes down to this deep sense of uncertainty and things feel like they're changing very, very quickly. And how do you plan for
I
the
feel
long
the
term
exact
when,
same way.
yeah.
Like it feels like the last, and maybe it's just because of where we live versus the current administration, but it feels like the last couple of years there's been a lot more conversation around that.
Hmm.
Uh, and you say, spanning across different administrations, but like I agree with you. Like this year to me has felt like more uncertainty than even 2020, which is
Hmm.
hard to believe that you're going through like that kind of cycle. And this year has felt like a lot more people trying to set up for worst case scenario.
Hmm.
And that's kind of why I asked the questions around margin loans and HELOCs and things like that, because it seems like more and more folks are trying to get themselves, I don't want to call it an exit strategy, but a plan B to
Hmm.
make sure that they're financially stable through what could be turbulent times.
Yeah.
And it's just nice to know that you could, obviously that's on the forefront of a financial advisor's mind, but you have a lot of levers to pull when it comes to that. Like the plan that you're putting together for your clients is okay, what do we need in the next 2 years, 5 years, 15, 20, 30? Let's map this out.
Hmm.
And if the worst case happens, here we'll pull this one. And if we don't, we pull this one. And
Yeah.
we're kind of a team that way too. It's like, all right, let's get a HELOC. You don't have to use it. It's a credit
Yeah.
card. If you don't take any money, then you don't pay any money. Like
Yeah.
let's do that. And I think that's so important for everybody to understand is that even though you have levers, you don't have to pull them. So, but getting them into place when employment is full and things are going really well at the time to do that, like planning for tax strategy sell it is the right time to do that, right?
Yeah.
Not when it's already done. Um, I've talked a lot about reverse mortgages in the past, and that's always a really hot topic with some clients because they feel like they're too expensive and they're challenging to get past the cost of doing that. But to me, that's just another lever that you could potentially pull with not going into the financial side. So I'll ask you a little bit about reverse mortgage, even though it's not something that everybody should have, but it's something that everybody should know. I think that reverse mortgages are an underutilized tool from that perspective with all the equity gained in this area over the last 5 or 10 years or even 20. And I've had some clients that have said, no, I want a HELOC. I'll say, well, but you have to pay it on a monthly basis. Like
Mhm.
you don't actually want to pay that money. Like a reverse mortgage, the balance just accrues. And what's cool to me about a reverse mortgage is if you accrue some sort of interest and then you pay it down, you still get a 1098 interest deduction, even though you don't have to make those payments. And I feel like over the next 3 to 5 years, reverse mortgages will become more of a topic that people talk about as a useful tool. I'm wondering if Brighton Jones has kind of talked about that anymore with some of the retirees, because that's been something that I've heard more and more questions about. And I'm doing a lot of education on it, but not a lot of people are taking action. So I'm wondering if that's been a question you've got from some of your folks that do have a lot of equity in your organization.
Yeah, more recently than and at any other point in my career. I feel
Yeah.
like it's because we're seeing these built up, hey, things are getting more expensive in general. Inflation, people are definitely feeling the hit of that. They've got a lot of equity built
Mm-hmm.
up in their homes, and that feels like the biggest bucket to be able to pull from, especially for retirees who, like, if you're lucky, you have a pension, right? But you're mostly
Well,
Social
and the hardest
Security
thing
and
too is like
yeah.
talking about with bigger costs. Like the bigger costs are going to be your insurance and your taxes, and like
hmm
you could have budgeted for retirement 12 years ago with the money that you had, but all of a sudden things have doubled, and now
Right.
you've sped up the money that you were going to use in 2030. You're using it now in 2025, and that all of a sudden feels like, oh my gosh, what do I do next?
Yeah.
And I think that's why I'm getting like fielding more and more of those calls. And like I think that that's a tool that is going to be utilized more and more in the future, especially as we get more of these boomers into retirement, like 60,
hmm
even like 59 and a half, you can execute that mortgage if you choose to. And again, it's like that credit card scenario where if you're not actually using that line, it's a very minimal accrual to the minimum balance, but now we all of a sudden have another line that we can execute. I think that's something that we're going to see more and more in the next 5 to 7 years. So that'll be interesting to look at
hmm
as well. But interesting to see that you field more of those calls too, because that's been a huge conversation for us, especially for those folks that are helping their parents try to figure out what happens between 65 and 95. And I
Yeah.
think that that's an interesting topic for sure.
Well, and I
Uh,
think the reason, sorry, Jim, to cut you off, but I think one of the reasons that we're seeing more of that is because, 5 years ago, you could just say, well, let's just refinance, right?
true too. Yeah,
You could do a cash out refi and your
yeah,
rate's going to
you're right.
be 3%, and absolutely your portfolio is going to outgrow that, but we're just not in that world anymore
Yeah,
where it
really
makes
good point.
sense to refi. And now what? Now where do you go to tap that equity for real in a real way that's going to put money in people's pockets today? So I think that's the difference as people have gotten used to the interest rate world that we live in. And I don't know, I don't think we're going to see 3% anytime soon, if ever again. Like
If if
that was
we
great, but
if we see 3%, we have really big problems somewhere else.
right. Yeah.
And I realistically, it'll probably take another epidemic to see something like that. And obviously, we don't hope for that. But like I said, kind of in the beginning, like I do think we could see low to mid fives in the next 18, 24 months. I don't think that's crazy, especially with the Fed's outline and what they might want to do in the next 2 to 3 years. That could happen. one big point on that though is you just can't chase rate like that.
Yeah.
It doesn't work. Like when you're chasing rate, your home prices is jacking up, and we've talked about this a lot in the office about that teeter-totter effect. That if interest rates are down, home prices are up, and that's something that you, I'm sure, see on the financial advisor side too. Like when
Hmm.
people are trying to chase, Nvidia or chase some of these like crazy stocks, and all of a sudden you see a pullback, and at the end, maybe you didn't make anything. And Nvidia is
Right.
probably a horrible example, but like in general,
It hung out around 134 for a while.
it
So.
did. It does. Definitely didn't watch that. um, so, guys, Katie, we're gonna let her go. If anybody has any financial advisor questions for Katie, please jump in and ask them now. Otherwise, we're gonna let her go here in the next couple of minutes. So, if anybody's got some questions for Katie, please jump on and ask them. Otherwise, we'll kind of jump into some more loan specific stuff, and we won't bore Katie with that. So we can we can let her go. Otherwise, please speak up, or we'll see her next month. Allie, what do you got? I know you're there. Iris, Jay, Liz, Zoom user, Mitsuki, Tina, Cindy, Alicia, Marla. Any questions? All right, Katie, you're free to go.
All right. Well, thank you everyone for having me, and I will see you next month.
Thank you so much for coming. I appreciate you.
Yeah,
Oh, Iris.
thank you.
Hey.
Thanks,
Yeah,
Kate.
I just thank you. Thank you.
No problem. All right. Everyone have a good night.
See you, Katie.
Bye.
Bye.
All right, gang, what do we want to learn about? What kind of loans do we want to learn about? I got them all. Iris, what's the big question?
Like all of them.
I can literally run through this entire presentation, or we can get super specific around loans that people want to know more about. Because I'm not sure who the Zoom user is that we have here, but I think it's a lot of real estate agents. So you guys tell me what you want to kind of learn more about. We can dial into those topics specifically, at least in more detail. So, what do we got? Any questions? Specifically, Iris, what do you got? I know you said all of them. We can certainly go through.
Oh, do you want to like run through just like quickly, like run them off, and then just as like a
Reminder.
like a
reminder.
a reminder. Thank you.
For sure. Yeah, we can do that. I'll just run through the whole like presentation, and then you guys just stop me if you've got specific questions around things, because I think that'll be a good way to do it. So
Okay.
let's start with like, and this is so basic, so you guys just tell me if you want me to move to a different thing, but like it's so important to understand that like pre-qualified versus pre-approved is so different. Like I could do a pre-qualification in like 6 minutes on the phone and scratch down some notes and say, yeah, you could probably buy something like 800. But if I don't see FICO scores and if I don't see like true income documentation and assets, then it's really not a pre-approval, because I've had 2 instances recently where clients are like, yeah, I make X, I've got Y in the account, and then I see credit and it's dead. So it's so important to at least see credit and income statements. That is the number one thing that I think a lot of clients don't understand, how maybe something that happened 6 years ago or even 2 years ago impacts today's credit. So that's super important. And really, qualifications, income, assets, and credit, we can use all sorts of different loan types. We've talked about a lot of stuff that are getting really creative in the non-QM. And non-QM is simply just like a non-qualified mortgage. The typical mortgage in the past was always like you had to have 20% down with W-2 income, assets for closing. Basically, since like 2015, we've seen a lot of these loan programs open up where they'll say, okay, if you have $3 million in an account, you really don't need it in monthly income. You've got a lot of money at hand that you can use. That's what a non-qualified mortgage is. So in that case, we could use something like an asset depletion loan that I've talked a little bit about in meetings. Or if somebody wanted to buy an investment property, they could say, well, I want to buy this investment property, it gets 4,000 a month in rent, and then I could basically give them a mortgage that was $4,000 a month in principal and interest, taxes, and insurance, and that would offset the rents. So their income doesn't even matter anymore because that mortgage is now covered by the rental. So if somebody wanted to be an investor, they could potentially purchase a house, even if it didn't fit inside the debt to income ratios. They could just buy that property because I could get a rent schedule from an appraiser that would show me that this rent is going to offset that mortgage debt. So even though income, assets, and credit are super important, even in that loan scenario I just gave, which would be a DSCR loan for an investor, they still have to have a good credit score to be able to qualify for that. They still have to have about a 700 plus credit score for that DSCR loan. For an asset depletion loan, we're basically just taking a percentage of the total loan amount that we use. Alicia, this is what we used with your client from about 5-6 months ago. We basically said, okay, you don't have like great income from a monthly W-2 perspective. However, you've got really good assets. So let's take this lump sum of money that we have, let's divide it by 84, and now I've got a monthly income stream because I can show that over the next 5 years, or excuse me, in that scenario it'd be 8, that you've got enough money to pay this mortgage off. So because we've seen like the mortgage markets open with different options, credit has become almost more important than income and assets has over the last few years, because with really good credit, a lot of these loan programs open up for folks that provide really similar terms to doing like a traditional qualified mortgage loan, which would be your W-2s, your pay stubs, and your assets. So a lot of this stuff has opened up dramatically, which has been awesome. Let's talk about bridge loans. So this was in my presentation today, and we talked about it a little bit. There's so many ways to do it. So, Katie and I were talking a little bit about kind of like this one here, this margin loan, and using your own funds as far as like a bridge loan goes. It's way cheaper to borrow your own money than it is to borrow somebody else's money. So, like if you're using a bridge loan, for example, and you're going to get a home equity line of credit, that's going to be about $3,000-$4,000 in cost, because you're adding another loan to your current debt profile. On top of that, you're going to pay somewhere between about 6 and 8% in interest on a monthly basis, and you have to make that payment on a monthly basis in order to use the down payment funds from your current house, property A, to go buy property B. Traditional bridge loan financing is really just trying to find the gap between I own this house and I want to buy this house. There's lots of ways to do a bridge loan. Like I would love if we just stopped saying bridge loans as an industry, because there's so many ways to get there. You can use your own funds in a margin account. You can use a home equity line of credit, or you can use the Windermere True Bridge Loan, which is basically a home equity line of credit through Windermere's Vantage Home Loans. And we work with those guys direct. They basically just set up a HELOC that they could fund in like 2 weeks. And they're so inexpensive. It's awesome. They charge about 1% of the money used in that bridge. So let's say you had a $2 million property, $500,000 loan on it, and you use $750. They're going to charge you about $7,500 in cost to use that loan. And then they're going to charge about 9% in interest month over month. The cool part about the Windermere Bridge, though, is they're just adding that to your current debt. You're not making a payment on it monthly. That's why the Windermere Bridge is so good over a HELOC, because you're not making the payment on the Windermere Bridge. But on a HELOC, you're actually making 3 payments. You're making a payment on your current mortgage, the HELOC, and then the new house that you just bought. The goal is to sell the house that you're currently in before you're making that first mortgage payment. As a reminder, like let's use today, it's September 23rd. If we close October 23rd, you don't have a mortgage payment until December. The goal would be to buy that house, sell your current house so you don't have a double mortgage payment in December. But if you didn't and you use the HELOC, now you've got three mortgage payments. You've got the new house you bought, the house you just moved from, and the HELOC. With the bridge, you have the new house payment and the house you just moved from. That's why the Windermere Bridge is so successful, is because you don't have to pay that on a monthly basis. It's just accrues to the house that you owned while you were transitioning into the new house. I love the Windermere Bridge program. It is so easy to use. It is by far the most inexpensive. There's also like 3 other bridge loans that we have. They charge like $30,000 to use them, but Windermere only charges 1% of your money that you've actually borrowed. It is by far the most inexpensive. I love the Windermere Bridge. So they save clients, and again, I say this all the time, because you guys are Windermere brokers, I would be touting this with the Windermere Ready program all the time. So you should use me because of these 2 loans, period. And we don't charge more being Windermere versus Compass, or being like Coldwell Banker, or being Sotheby's, any of these different companies. But your client saves so much money with these 2 loans. Because if I work with a Compass agent, I've got to use like, oh God, what's the name of that one? Anyway, they charge like $33,000 to use their loan. It's 2.25% of whatever money's borrowed, plus title escrow, all the other fees. Because you're Windermere, you save your clients so much money in that loan scenario. It truly is wild. So I love the Windermere Bridge. You can also do what's called a cross collateral loan. A cross collateral loan is basically refinancing the current loan, adding another house purchase, and if you have 25% equity between house A and the house that you're now purchasing, house B, then you don't have to bring any money to closing. But it's 2 loans that are happening simultaneously. It's basically refinancing the current house they have and purchasing the next one. And you're basically putting one large loan over 2 properties. And when they sell the other one, they drop this loan amount down. And that's also very expensive. That's 2.25% as well. So that one we try to stay away from if we can, but it's an option that we get to if that's the only option that works. Why we do that loan is because there's less to the debt to income ratio. When you're looking at the Windermere Bridge, they do have to qualify with both payments, the current house and the new house. So my goal is always to, 1, save closing costs at all possible. And I run through all these options basically in a row. I go, okay, do you have retirement accounts? Can we use those? Okay, we don't have enough retirement accounts. Can we pull a HELOC and qualify with 3 payments? Okay, we can't. Can we do the Windermere Bridge and qualify with 2 payments? Crap, we can't. Let's go to the cross collateral loan and qualify that way, or it's a contingent purchase. So my goal as a loan officer is always to find the most inexpensive way to possibly do a buy before you sell loan, which is what I would love people to call bridge loans, because there's so many ways to do it. There's like 5 ways to do a bridge loan. And a lot of times clients will say, well, I'm not doing a bridge, it's too expensive. And like, well, what if we borrowed your own money? It's only like, this is happening right now with a client that I mentioned this morning. They're going to borrow their own money at 6.25%. And they're then going to buy this house, sell their house, and probably only make like $6,000 in payments over 90 days. That's pretty inexpensive to buy before you sell using your own money. And let's talk about like 30 days in an Airbnb. That's probably like $9,000 for a 4-bedroom house on the east side, which is where they live. So a lot of times bridge loans have a negative connotation with clients when you mention bridge. So to me, like saying buy before you sell is a much better way to approach a potential option that we might have. Because again, there's about 5 of them that we can use. And again, it's personal finances, HELOCs, then it's Windermere Bridge, then it's one of these other loans that we can look at. Cross collateral is last, in my opinion. So a lot of ways that we can do that. But bridge loans, and I mentioned it this morning too, if you can buy in the fall and sell in the spring, that is just a win-win in my opinion. And I think that right now, specifically with the way interest rates are trending, with what I think 2026 is going to be a very good year in real estate, especially if we get a little more alleviation in rate, we get some more positivity from the news outlets with maybe one or two more rate drops. Like, you're going to start to see more people come to real estate. You just are. And I said this about a month ago in office. Like, this year was different than it was supposed to be. Like, there were supposed to be 6 rate drops this year. We just had our first one in September. Like, this year is supposed to be different. And, because of, my opinion, some employment reports that didn't quite hit the way they were supposed to, because of some political stuff between Powell and Trump, everything's gotten delayed. And I think this is all coming down the pike, which is why I brought up that dot plot to start this meeting. Like, at some point, the Fed funds rate is going to be about 125 to 150 basis points less, which should equate to about 1 to 1.25% lower rates than today. If we get 5% rates or 5.5% rates, I think it's going to be crazy. So that's what I truly think this outlook looks like, and I think it's about 9 months delayed from what it should be. Alicia, does that apply to buyers, sellers that want to move to other markets across country? Yes, you can do a bridge loan across state lines. So yeah, you can do that. Let's see. We've talked lots of different loans here. We'll go through them individually. Non-occupant co-borrowing and gifting. I think this one's super important to understand. Gifting does not matter for almost every loan type. Even jumbo loans now, you can get a big gift for almost all of your down payment. So that's not really going to impact anything. Non-occupant co-borrowers, you're there for income. If you're there for income, then that's why you'd be a non-occupant co-borrower. If you just want a gift, then you're probably not on that loan. Because if you are a non-occupant co-borrower, you do need to be on title as well. So I think that's really important for everybody to know. If they're a non-occupant co-borrower, they've got to be on the PSA, which then makes them on title. If they just want to help with a purchase, whether it's a family member, like a mother, father that want to help their kids, or if it's kids help the parents, whatever that might be, then they can gift that money and they don't have to be on title. That's a really important part of this. I always highlight this. We do not report to the IRS. So a lot of times, some families use like gifting almost like a bridge loan. And I wouldn't put that in an email, but it is something that happens quite frequently. So sometimes family members help people as far as a bridge loan goes. We talked about this in office too. I do think this is a really good strategy for family members to maybe put in place like a promissory note to potentially help son, daughter, mother, father, doesn't matter, try to get from point A to point B. And maybe they gift them $500,000, but on the back end, they're actually make a little money on their money, because like Katie and I talked about, for a long time, you can make between 4 and 5% on just cash. And if that's the case, and somebody's going to lay out cash for 4 or 5 months to help somebody transition from one house to another, maybe there's a little back and forth that happens there between family. For us, we call it gifting, because if they give it back, no problem. Like, that's between family, especially if it's in the same tax year, then that's not going to create any sort of IRS problems. But we do not report to the IRS. That's incredibly important. You used to have 5% of your own funds. This is now going back 3-4 years. Fannie Mae, Freddie Mac took that away to no longer make the the occupant borrower who's buying the house have their own 5%. That's been taken away, which is great. That alleviates a lot of stress too when it comes to family. Conventional loans in general. This is by far the most, I'd say most common loan that we see is conventional loans. Typically 700 credit score and above, you're going to want to look at a conventional style loan, just basically due to what PMI requirements are there for conventional versus FHA. So conventional loans, you only have to have one form of mortgage insurance. I think that's super important to note. If you have like a 640 credit score, though, conventional loans sway their mortgage payment, or excuse me, their PMI requirements based on credit score. So if you've got a 770 credit score, then you're going to have a lot cheaper PMI than somebody that has a 670 credit score. And sometimes that might push somebody with a very low down payment, 3 to 3.5%, into an FHA loan, because you might save money monthly. And FHA loans, from that perspective, are going to have slightly less interest. So when interest rates are lower on FHA versus conventional, plus their PMI is cheaper, then that might be the right way to go if you're a low down payment client. And that's always been kind of a question that I get is, hey, I've got a low down payment, I got to go FHA. That's not always the case. Like sometimes having a lower down payment with really good credit, it's actually going to be advantageous to go conventional. And that's something that I've heard a lot from real estate agents in general is, well, I've got a FHA buyer. I'm like, well, do you know what their credit is? I'm like, no, but they're 3.5% down. I was like, cool, conventional goes to 3. So maybe that's something that we can remember too. Is just because they have a lower down payment doesn't mean they have to go FHA. So I'm going to bring this screen up too. We talked about this a little bit today, but mortgage rates on FHA, as you can see, are closer to 6. So you're going to save about 3/8 going FHA than you would conventionally. So if we do have a low down payment, maybe FHA is the right route to go to. Maybe it's not, but we can always do that during our pre-approval time. So that's something to look at as well. The other thing about FHA, a lot of people say like, well, is it FHA approved on a condominium? Well, maybe not. The reason why it wouldn't be FHA approved is because if a condominium, basically the FHA approval only lasts like 3 years. So if you were an HOA president or if you were an HOA in general, it's pretty expensive to get FHA approved. It's probably about $4,000 or $5,000 to get a full building approved, maybe even 6. But we'll do FHA spot approvals for condominiums. So if you have a condo that's probably somewhere like sub 450 as far as a price goes, then it might be advantageous to send that to us because we can look at the resale cert, and as long as there's nothing crazy on there, we can probably do an FHA spot approval on that condo and get you the ability to add another potential loan to this, to your listing. So if you now have the ability to open up to FHA borrowers, maybe that's advantageous than just this conventional. So something to note. Again, we do FHA approvals spot-wise. VA though, VA has to be approved.
Wait, Jim.
Oh,
sorry.
yeah.
Sorry, I have a quick question. What does spot approval mean again?
Yeah, so spot approval on FHA is simply that we can do a single unit FHA approval on a condo. So
Okay,
traditionally, the entire building needed to be FHA approved, and that was really expensive for HOAs. And HOAs didn't want to pay for that, especially like 2018 through 2023, where the mortgage or the market was moving fast. They weren't going to make that month or annual expense as an HOA to get an FHA approval. But like our company at Movement will actually do an FHA spot approval on a single unit, and we'll pay that expense. Like it doesn't go down to the homeowner, it doesn't go down to the borrower. Then we'll actually do that so we can get an FHA loan approved. So if you have a condo that is, like you said, price sub 450, because that's typically where we see FHA low down payment options work on condos, then you can send it to me. Or if you have an FHA buyer that is going after a condo that's not currently FHA approved, we can potentially get it FHA approved for that client specific.
Okay.
Because like what we can't do is like just get it approved for no reason, for lack of a better word, because it does cost a lot of money to get it approved. But if we have a client that's after it, then we can do it for that client because we're getting the loan for it. So just because it's not currently FHA approved does not mean it can't be FHA approved. So that's important to note on the FHA condo side.
Okay, thank you. That was
Good.
really helpful. Thanks.
Cool. In general, I had this question come up a couple days ago. So in general, if you've got a single family house or if you've got a detached condo, like we're seeing a lot more detached ADUs and condos now in like Kirkland, Bellevue, a lot of Seattle. You've got like those four to maybe five to $600,000 detached, whether condominiumized single families. Like those are FHA approved and those are VA approved too. Even though they're technically condominiums, those can be all of the different types of loan sources, VA, FHA, conventional, all of those will work. So when I see like a detached condominium and they say conventional only, like that's just not accurate. So just know if you have an FHA or VA buyer, just because of the detached condo and the listing agent didn't put that type of financing on the listing, it doesn't mean it can't be done. So that's a really important note for you guys too when you're talking about different loan programs. VA though, when you're looking at VA for condos specifically, because we're kind of talking about condos right now, VA has to approve the building. So if that building is not VA approved, then there's no single spot approval on VA. You can't just do like a single unit like you can FHA. But VA loans, I just love VA loans. Like they're so buyer friendly. Like they'll go to 55 debt to income ratios, sometimes 60 if that client's got assets. They're so loose with their requirements because it's for our veterans and they really want their veterans to get into a property, for lack of a better word. They don't have any PMI. Sometimes they'll have a funding fee. It's all about what kind of basically what kind of career they've had or what kind of branch of military that they've been in. If that funding fee is going to be 1.25% or 2.25% or whatever it might look like. There's lots of branches too. Like you could be in the reserve for, gosh, I think it's 12 years to get a VA loan. Maybe it's 8. I can't remember that exactly off the top of my head, but typically VA loans are really well priced too. Like right now you can get a VA loan sub 6%, probably about 5.8, 5.9, where conventional is more like 6.3 on average. So the VA loan to me is my favorite loan. They can go to 2.5 million and more than that with zero down. Like there's so much flexibility on the VA side. I absolutely love it. So you'll typically see those about 0.5% lower than conventional. Right now it's a little tighter spread, but in general it's about 0.5% less than VA loans than it is conventional.
Okay,
oh yeah, good.
Sorry, I have a quick question on the VA loan. Is there anything that would be stopping someone from getting a VA loan? Like what would that be? And why?
Yeah, they got to be military background. They'll have to have either a
Right.
like DD 214 or certificate eligibility telling you what their qualifications look like.
Okay.
Their spouses can also use the VA loan if somebody's been deceased. It's really
Okay.
flexible. Like that's what you
But
need.
as long as like there's military background, then there's no reason why like you wouldn't qualify.
There's you still have to have a job. You still have to have income. You still have to have assets. You still need to have like all the traditional
Okay.
requirements. Down payments. Like I'm doing a VA loan right now for a guy that is purchasing at 750. He's doing 0% down. He put $20,000 in earnest money down because he wanted to show the seller that he was a serious buyer. However, his total closing costs are only going to be like $11,850. He's going to receive $8,750 back at closing because his earnest money is actually more than his closing costs in setting up his impound account. So, like in that scenario, like this person wanted to show strength to the seller because he was doing zero down, but he's actually going to get money at closing. It's a really funny phenomenon when you start to think about it. But it truly is a great loan. But you still need to have income. You still need to have assets to be able to qualify.
Gotcha. Thank you.
But love the VA. One big common misconception on VA loans is that the seller is going to have to pay for the buyer's closing costs. And so where that comes from is, as long as the closing costs are less than 1% of purchase price, then the seller never has to pay for the buyer's closing costs. Where this would come up is if your client was using a mortgage person who's a broker. I'm not a broker, so our closing costs are really inexpensive. Like, we don't charge 1% or 1.25% origination fee to write loans. Like, we just have a $1,500 processing underwriting fee. If that person, or if a lender charged all of those costs in addition to what we do, then the seller might have to pay for title and escrow. That's where a lot of sellers say, well, I don't want a VA loan because I don't want to pay their costs. If you ever heard that statement, that's where it comes from. But when you're working with a lender like myself, we don't charge that 1.25% fee. So we never hit that barrier, so that sellers don't actually get impacted with our VA clients. And I think that's important to know too. The only other thing that we lose control over on VA loans, and this is on condos or anything, is like that same client I was telling you about, it's closing in mid-October. Like, it takes 3 weeks to get an appraisal back right now for a VA loan. So you can't really close those in like 20 days unless you get an appraisal back super fast. And about 6 months ago, we were getting appraisals back in about 10, 12 days. But now the VA appraiser is a little busier, so it's more like 3 weeks. So we do need about 30, 35 days on VA loan closings. And that's not a movement thing. That's just because it has to go to the Veteran Affairs Department, and they control the appraisal turn times. So those are the two things on VA loans that people sometimes get irked by. In my opinion, like, they're fantastic. The other thing that VA loans do is they're a little more scrutinous on the safety with homes. So like, they're a little bit more scrutinous on crawl spaces, attics, loose deck boards, railings, safety issues like that. But traditionally, you're going to kind of know when you go to a home if it's well put together or not. We've had very few instances where the VA loans were just like more scrutinized than conventional, because realistically, it's the same appraisers that are doing VA loans versus conventional. They just have to check some more boxes on the VA appraisal side. So there's really not a massive difference on the VA versus conventional from that perspective. But those would be like the three things that, and specifically with listing agents, like, I make it a point to call every listing agent when an offer goes in for one of our clients, but specifically around VA, like, I will hound a listing agent to make sure that she talks to me or he talks to me, because like, VA can be one of those things that somebody's had a bad experience with. And if they've had a bad experience with a big lender like USAA or like one of these national lending institutions that don't do the same pre-approvals that we do, and things went south, then I just want to make sure that I get through to them that, like, hey, this is the same pre-approval that we do on a conventional and jumbo loan or FHA. Like, it's just a VA loan, and like, we can't get the appraisal back faster than the VA will give it to us. But there's no reason for you not to accept this if the terms are right. So that's a really big point that we make on the VA side. Jumbo loans in general, like, you really can do now as low as 5% down. These loans go from $807,000 all the way up to $5 million on loan amounts. There's actually broker lenders that we have now that'll go like 7 or 8. The biggest thing with jumbos is they're a little more scrutinized because they're all investor money. So when you're talking about like conventional loans are backed by Fannie Mae and Freddie Mac, they have their own requirements. VA loans, FHA loans are really government backed and they have their own requirements. Same with jumbo. But like jumbo loans, they're written by investor money. So it's like Chase actually writes their own paper on these, or Citi, or Bank of America, whoever it is, and they're going to have their own requirements. So typically on jumbo loans, you're going to need to have a little more scrutiny, and that includes a tax returns for the last 2 years. If they've got K1s or they've got income that's declining, like sometimes those will create more issues with clients because they're just scrutinized a little bit more because frankly the dollar amount a lot more. And that's something that we see sometimes, but it's typically not anything crazy. Jumbo loans have been so much more, I don't want to say popular, but obviously in our price points in our area, we see a lot of jumbo loans. And you can kind of see some of those red flags pretty early when it comes to jumbos. But we now have loans from 5 to 30% down. And I think Carrie said it last week that she's seen some arms in like the mid fives on 7-year arms. And we saw that probably 2 weeks ago. I think those are a little bit higher than they used to be now, closer to about 5.8, 5.9% on a 7-year arm, where you're seeing jumbo money at about 6.25. But in general, jumbos are happening pretty fast. Those close in about 3-4 weeks as well. So those have been going well. Mortgage insurance, I bring this up because a lot of people don't know there's 4 types of PMI. Mortgage insurance is basically any loan that's not a jumbo less than 20% down. So why this is important is if you're in a really low interest rate environment, and I did this a lot in like 2015, 16, 17, 20, 21, and part of 22. Like if you had less than 20% down, a lot of times I would finance a lump sum of PMI instead of having the client pay it monthly, because I would rather finance $3,000 or $4,000 or $5,000 in a lump sum at 3 to 4% interest than I would to have the client pay like $140 a month. Because those break evens, like we always talk about points, they were like 4 years or 5 years or 6 years. And I bring it up because the market dictates what type of mortgage insurance makes the most sense. Like right now, I would never finance somebody's PMI because I think they're going to have that loan for less than 4 years. And I've felt that way for like 2+ years. And I've been pretty accurate with those clients over the last couple of years that bought +7, and now rates are in the low 6s, and a lot of them are refinancing or getting different types of mortgages. So I'm not a huge fan of financing this type of lump sum into a loan right now. However, if we saw rates at 3.5, I would probably finance it. You know, one thing I would look at right now is lender paid PMI. Instead of paying a $150 a month premium, I might suggest to a client that they pay a quarter higher in interest rate, because the quarter higher in interest rate is probably close to the same monthly payment as monthly PMI, and they get interest deduction from it. So that's a hard thing for clients to understand, and it takes the right client to want to go that direction, but it's something I propose because it makes sense to me when you're talking about taxable benefits on PMI versus interest deductions. More of a next level conversation. But just know that there's 4 different types. There's finance, there's upfront, there's monthly, and there's lender paid. So there's not only just one type of mortgage insurance. I've had to recently I had to have a client do the finance, or excuse me, the upfront PMI version paid for by the seller because they did not qualify for that purchase price without the seller paying their PMI. They bought something at like 580 and they're really only pre-approved to 560. But if the seller paid their PMI, now they're approved to 580. So that was the solution to the client really wanting a home above their pre-approved amount. But the only way we're able to do that is with an offsetting seller credit. So just so everybody knows that those options exist, and we can get kind of creative on the math there. That's why we look at different mortgage types. Down payment assistance in general. Washington State Housing Finance Commission is one that we use. There's another one out there now too that's really good. Basically what these systems do is they give about 4% towards the down payment, either on FHA or conventional. Now, the client's still putting 3 or 3.5% down for one of these different types of mortgage products, This down payment assistance program is basically giving that to them at a 0-interest loan. There is a second loan added to that purchase because the Washington State Housing Finance Commission isn't really doing this for free. They're just lending their money to this client for as long as they live in this house. So is it down payment assistance? Yes. Is it helping them get into a property? Absolutely. And they're creating wealth and appreciation by property ownership. But at some point, this Washington State Housing Commission gets repaid. And they basically do that through their terms. The Washington State Housing Finance Commission sets interest rates. So if you use myself or any other mortgage broker or mortgage provider, not actually a broker, in Washington State, they would have the exact same terms. So like when we get clients like, well, I don't want to pay 7% when the mortgage market's at 6 3/8. Totally get it, but that's the cost to use the state's money to help you get into this property. And that's really what down payment assistance is. So these programs are awesome. They're really great to get people into properties, but they do come with higher terms on a monthly payment side. The flip side is you really don't need much, if any, cash to buy your first house. So they're great, but if you can come up with your own down payment, you're going to get better terms in general on the mortgage side. This one's huge to me when you're looking in different counties. So if you're looking at different counties, like King, Snohomish, Kitsap, and Island counties, you can see these 1-unit loan limits change. And why this is so important is if you were looking in a certain area and all of a sudden that client says, what about this house over here in Island County? And you were approved for a conventional loan at 10% down. Let's say you're at $1 million purchase with 10% down. And then all of a sudden you went to Island County, you're no longer approved because that property is in a different county that has different county loan limits. So it's important to know like what type of loan that your client is using and what those limits are in those certain areas. And of course, we'll help you with that. But it's just important to note in general, or you're looking in different counties across the board. Do's and don'ts. This one's super straightforward. Like when we have clients that are under contract, we just tell them to act the same. Like, don't get a new car loan. Please don't change jobs. Like, don't do any of those things that's going to change your financials. That's super important when people are under contract. If they're pre-approved, and I've talked about this a lot in office, and they're salaried employees, all of a sudden they go to another big tech company, they've gone to contract, they're no longer pre-approved. Like, that's the best example I can give because we've seen that sometimes. And that is just horrifying for a client to think that they just went to another tech company, they're making more money, but they have an expiration. That contract expires in 11 months, and we don't know if they're going to get another one. So that's a really big thing for everybody to know when they're looking at pre-approved clients. And something, if a client ever says, hey, I'm thinking about taking this job, like, please call Jim first and talk to him about it, because that is a decline automatically from any loan provider, FHA, VA, conventional, jumbo, doesn't matter, because we do not know if they're going to get that job again 11 months from now when that contract expires. So that's a big one. What else you got? That's what I had to share. Questions, comments? No, Liz, yes, no max on gifting. There, you can literally gift. Gosh, what's the limit now? I think it's 12,800,000. I think is the current lifetime gifting limits. So yeah, gift away. And it's all about the gift. The person who's giving the gift, that's the person that has to worry about tax implications. I've had a couple of clients that like, well, I don't want to give, and this client's name was Jeff. I don't want to give Jeff X amount of dollars because that might wreck his taxes. I was like, doesn't matter. That's a gift to Jeff. You have to worry about your taxes. And they still basically had to write a little family contract that says Jeff's going to pay this back in the future. And I said, do whatever you want. But Yeah, it's the person who's giving the gift that has to worry about the taxes versus the person who's receiving it. So that's a big one.
So I have oh, hang on. Okay. Oops. It's better. I feel like it's better when the video's on. When I'm talking. But so I have a question about the gifting part. If you're writing up a purchase and sale agreement and there's a gift being given, at what point, I don't know how to ask this exactly, but at what point, like when do you show that there's a gift being used? Or how does that work? Does that make sense?
Yeah, it totally makes sense. So
Okay.
from the lending perspective, on my side, like, we're basically relying on that gift. I typically
Okay.
tell clients to have their parents or family member send that directly to escrow because that's a really simple way for us to track the paper trail of that. If they gifted, like, let's say my mom gave me 50 grand and it came from her account to my account. Now I need to see her account statement, my account statement, and those things need to match. And then I need to send all that to underwriting. If she just sent it straight to escrow, then escrow would get a receipt, kind of like earnest money. And then I would send a gift letter as a lender to, my mother, Jackie, myself. We'd all sign it that basically states that I, Jackie, am giving my son, Jim, $50,000 for a purchase at X place. And we'd all sign it e-sign wise. And that's the only documentation I would need. So from a loan perspective, we don't really document it from the gifter until it's actually received. So it's really important that if somebody is going to do that, everybody's on the same page. Like, because if they don't do that, then that deal is probably blown up because money never arrives. I actually have this was crazy. I had this happen, like, gosh, 7 years ago. Like, this gal's sister was going to give her, I think it was 80 grand. And we were all relying on that. We had underwriting approval, docs were sent, everybody had signed, and she just never sent the $80,000. And we're all like, is this money going to happen? It's like, oh, I'm in China. I'm really sorry. I can't make that happen. And the deal fell apart. So from the lending side, we're really kind of relying on that happening. But from a contract side, I think you do have to state in your contract that there's a gift involved. I believe that's a box. That's more of a Tyler question, but I think that everybody has to be aware that that is happening.
Thank you.
Yep. Easy. What else, gang? 7:03. Ready to watch the M's?
What?
It's 7:03. Anybody have any more questions? Ready to watch the Mariner game?
Oh, the Mariners. I'm going to a soccer game. My daughter's playing tonight.
Oh, fun.
Jim, it was confusing. I just did one of those recently, and the parents gave like 300 grand towards the purchase. And the lender was saying, I want their names in the contract, but we were also making it clear that parents were not going to be on title. So when we threw the parents in on a Form 36, or not the Form 36, 22Z, I think it was, additional signers, it confused title, and they were thinking that the parents were going to be on title. They were not. They were just gifting that big chunk.
Yeah, that shouldn't have happened. Because the only time, the gifting wise, no one has to be on title. Nobody has to be, because if you're on title, you got to be on the PSA. That just shouldn't have happened, Liz. I'm not sure what the miscue was there, but like from a gifting perspective, you do not need to have that kind of documentation for somebody who's just given a gift. You have to document who they are in relation to the client that's purchasing. Like for us, it's a very simple PDF that we send out to all parties. We'll just ask for the email addresses of the parents, and we would send that to the 2 or 4, whatever, how many parties are associated with that transaction. Everybody have to sign it in agreement that this is a gift that was happening going straight to escrow, but they should not have been on title there. And I think that's where the confusion happened with escrow. Is like, wait, who are these people? Why are they involved?
Right.
because
Right. So they
that's
shouldn't have they shouldn't have been named in the contract at all.
mhm.
Yeah. It was B of A, what can I say?
Yeah, that
Oh,
shouldn't happen at all. That was a myth.
so sorry.
The wrong lender, Liz. That's what it was. The wrong lender.
I wish I could have influenced that.
Yeah, that just shouldn't happen. That's an
Yeah.
odd scenario. It's that's definitely why title reacted that way, because that
Right.
that's an
But
odd.
then if parents are co-signing, like our
Parents are
previous thing,
co-signing. Yeah, parents are co-signing. They're on the PSA. They're on the loan documents. You're basically just putting everybody's income, everybody's
mhm,
assets into one big pot, and everybody's on that loan together. That's the income addition that we're looking at for non-occupant co-borrowers in that scenario.
right. And they have to be on title then.
On title, on PSA. Yep.
Right. So just for the other agents in here who aren't sure how to squeeze that in, the 22Z. So you don't have to put 4 signer spots on every little piece throughout the contract, but you can use the 22Z that's naming additional signers. Makes it easy.
Mhm. Yep.
Perfect.
Yeah, and for us too, you just a lot of times it's hard to do 4 people on one application, so you do
Hmm.
Jim and Bree on one application, and then Jackie and Rowan on another application, and we combine them on our end to make it easier on
Hmm.
everyone.
Hmm.
So you don't have to try and get 4 people in a room trying to one
Right.
one electric document. So,
Hmm.
yeah, good point. That's the big difference. Co-signers are for income, gifting is for assets.
Hmm. Perfect. Thank you.
Yeah, for sure. What else, gang? Cool. I'm gonna end it.
Yay.